So right now, there's three kinds of real estate investors. So the first group, they're the ones who don't know anything about the tax rules that are out there. They file by the seat of their pants, turn everything into their tax preparer the night before. You know who you are. They're walking onto the field thinking they know the game, but the scoreboard and sport is completely different. The second group, they're a little better, but unfortunately, they're still playing by last year's old rules. We got the one big, beautiful bill that was passed. Those are the old rules. There's old rules, and now we got new rules. So they're filing taxes the old ways, missing deductions and strategies they don't even know exist. And then there's the third group, and I'm going to bet that you're in that third group if you're watching this. You learn there's a new tax playbook, and you want to use 100% bonus depreciation, cost segregation, and other smart strategies to win under the new law. Well, tonight we got Greg Taylor from Taylor Tax Strategies. He is going to share how you can play the game to win in 2026. Hey there, Christian Walsh with Wired Associates. We've been helping the smartest buyers and sellers make the best data-driven decisions. We got Michelle in the background, so post your comments, keep them clean. Remember, this isn't tax or legal advice. And one other important thing, there's Greg. It wouldn't be a show without Greg. Thanks for coming, Greg. We appreciate you being here.
Thanks for having me.
So this is actually, we appreciate you coming on because this is a big day for certain filers. Correct. What was today's deadline?
That first group that you mentioned, those who are stumbling onto the field at the last minute. So,
hey, I might resemble that. Be nice. Be nice. That's because I just hired you. That's why. I'm transitioning. I'm switching teams, going from an old team to the Greg Taylor team now. But yeah, so today is if you're a sole proprietor, for example, an individual, and you filed an extension, so it was your taxes were due today. So
yes,
we appreciate you.
Unless you were in a FEMA designated disaster area, and then you have an additional extension. So
yeah, and in the FEMA designated disaster areas, they didn't actually have to pay their taxes either. So it's not like they're late on filing and late on taxes. Correct.
That's right.
Yeah.
Yeah. Kentucky, the whole state of Kentucky, the state that I'm in, where a lot of my clients are as well, is basically it's till November 3rd. And so a lot of people are holding back on estimated taxes for all the quarters. You know, they're holding back on that amount due for April 15th. I have clients who got their taxes done April 15th and they knew what they owed, and they are holding on to that money until November 3rd because that's when they have to pay it. So
hey, that's a smart move.
January to November for free. So
yeah, smart move to make. It's free, a free loan. So no, that makes complete sense. So, and speaking of Kentucky, Louisville's where you guys are based. You're helping people in 48 out of 50 states with their tax.
I have news.
Oh, what's the big news? Tell me.
We got somebody in Alaska. So.
Yes. Congratulations. I know you said you had one who was on the fence. So
it wasn't even that person. It was somebody else I didn't even know about.
You landed the well. So I just updated my notes. I moved that 48 to 49. Congrats. We just need to get you Hawaii. Is that what's left?
Hawaii. Yep. I think that's the only one. So
all right, we'll get cracking on that. So Greg and his team, they're tax strategists. He's got a whole team of bookkeepers, CPA, IRS enrolled agents. Who else do you have there?
Yeah, so we have the bookkeepers, the data entry, the preparers, the strategists, and we have, obviously our marketing and sales team and all that stuff. But as far as that goes, we have accountants, we have CPAs, enrolled agents. Yeah, we kind of cover.
And you guys, like you said. What I love about you guys is you're there for property owners because it's not always easy to find the advice you need for real estate, and then small business owners as well, like real estate agents and other small businesses. So you guys are there to help. So
that's right.
Let's talk. So I know it's still 2025. We just started the fourth quarter, but let's talk about planning for 2026. I've got some questions for you, but give me kind of a 30,000 foot level. What are you doing to help your clients prepare for 2026? Are they making big moves, little changes? Give me a 30,000 foot level and we'll dive in a little deeper.
Yeah, so I guess 30,000 foot is kind of hard because it's a lot of those little things, but it's really looking at the numbers and the different things that you have going on and getting some projections of what you're thinking your revenue and profit are going to be if you're a business owner for 2026. That's kind of the place to start.
So the one big beautiful bill, uh, this is going to be the first. 2026 will be the first tax year that you can actually take advantage. Some of the stuff, it was January 19th, so pretty close to a full tax year. But 2026 will be the full tax year. Is
The
there
first
any?
full year. Yeah, that's right.
Yeah, is there any urgency? I mean, do we have to worry that in a couple years, or what are your thoughts on that?
Um, I mean, the big thing with all the bonus depreciation and all that stuff was made permanent.
Yeah.
So there would have to be new legislation to undo it at this point. It wasn't one of those things that was set to expire after a certain number of years, like a lot of credits are and things like that. So, I mean, I don't want to say it's here to stay forever, but it is currently in the law that way, right? So it's currently in the law that this is the rule you play by now. And so somebody's got to change the rule again, whereas in the past it was we're going to do this for a certain number of years and then we're going to taper it off. So
Yeah. That's the big difference. This is permanent. So there's at least two things that we'll probably touch on. Definitely the 100% bonus depreciation. The other one would be the state tax guidelines. Those are permanent as well. So here, before we get into questions, All Nighter has some people in Hawaii. He's going to reach out so we can
all
get you
right,
all
thank
50
you so
states.
much.
Then we'll have to get you Bad Bunny so we can get Puerto Rico. But we'll
Yeah,
keep
there
it
you go.
rolling.
There you
We'll keep
go.
it rolling. So
I didn't
All
have
Nighter.
questions and comments pulled up. I'm going to have to look at these. So
Yeah, so he's got a big question. Because All Nighter, I'm a big fan and he's a fan of us. Let's dive into his question, then we'll go deeper. So he wants you to touch on deferred payments versus windfall and tax advantage for seller financing. Okay, then he says not deferred, but interval payments. Okay.
okay, good.
Does
I was kind of trying to figure out how they fit together. So
Yeah,
I'm glad we
interval payments
clarified
keep a
that.
seller in their current tax
Right.
bracket, while windfall can bump them into a higher bracket, causing more tax liability. Does that make
That's right.
sense to you, what he's talking about?
Yeah, yeah. So basically, when you sell a property, you would then, if you're selling a property on owner financing or structured sale, it's sometimes called,
Yeah,
then you can sell that, and as the seller, you record the payments as income as they come in,
yeah,
and so you're not getting this huge, increase in income. So a scenario where this could happen, we have step up in cost basis with inheritance, but let's say there's step up in cost basis happened 20 or 30 years ago, and we've been through a couple boom cycles since then, and
yeah,
now you're looking to sell. So even though you had the step up in cost basis before, this is kind of a big windfall for you now, because not only did you get that step up, but now it's gone up more in value. And so if you set it up so that the payments are monthly or quarterly and annually, then you're only claiming the payments that you receive that year as income. And so
yeah.
you are able to then defer kind of that tax liability by stretching out when you receive the income and when you have to claim it.
No, that's great. So I did it. I think All Nighter is asking this question because I think he's going to be buying an asset. I remember him talking about that. He's going to be buying an asset from a friend of his, maybe a couple assets, and they have discussed seller financing or installment financing. And that's actually how I bought my house, the one I just sold this year. Bought it
Okay.
from the landlord, and we did installment financing, seller carryback. And the reason being, if they did a 1031, there was nothing compelling at the time, so they could
Okay.
get a good interest rate from us. We also structured it so that they didn't have to pay any capital gains tax, because they didn't get enough money for capital gains in our down payment.
Right.
Then the payments were interest only, which helped us from a cash flow standpoint. So it didn't trigger, again, any capital gains tax with those. They just had to pay income on the
Right.
interest payments. And the only big surprise for people, and they were represented by another agent, so we didn't discuss this. I didn't warn them. But in other cases where we've discussed this, is the depreciation recapture. People
Yeah.
don't realize they will have to pay that immediately, even in a structured or interval payment setup like this. So
Yeah. The depreciation recapture. Yep.
Yeah, that's a big deal. And so yeah, all nighter is going to be the buyer. He's looking out for the seller. Yeah, that's a smart way to do it, all nighter, because that's you want to make sure it works for your. It's a friend of yours, so you want to
Yeah.
make sure it works out for them, and you can structure it then more effectively to actually meet their needs in addition to your needs. That's what's great about seller financing. Everything is negotiable, from price
Right.
to terms, literally everything. So I want to jump ahead in questions because this is actually a good segue. The bonus depreciation this year for real estate that's put into whatever work, uh, January 19th or later, you can do the 100% bonus depreciation. Are there any red flags or anything to watch out because of the fact that, like we talked about, depreciation recapture? Like if you took 100% depreciation for 2026 and sold in 2027, your basis is going to be low because of that. So give us some advice on that. Is there any scenario where it wouldn't make sense to take the bonus depreciation?
Yeah, typically, if you're going to hold it for less than 2 to 3 years, you want to really consider hard if it's worth the bonus depreciation. I do have one client that he'll buy a property, cost seg it, bonus depreciate it with the intention of keeping it 1 year. And he's not
Yeah.
breaking any rules by doing that. And he knows, that he's playing this game and that he's getting the benefit this year. It's worth the money to him that he pays for the cost segregation study. But then he sometimes sells it at 366 days. And so just barely gets, over the year mark. And so that's a strategy that he understands. He wants to implement, that kind of stuff. But for most people, I typically advise that if you're not going to keep it 2 to 3 years, you need to really know that you want to do it that way and that this year needs to be fixed for you. And you don't really care about next year in order to do that.
So when that client hypothetically were to do that, does he do a 1031 exchange into the
Sometimes
next?
and sometimes not. So yeah,
So he'll just
sometimes he'll just take the
just
hit.
pay the
Yeah.
recapture in some
Yeah, but
cases.
he's buying so many that he ends up absorbing it with other ones. So it doesn't really for him. He's kind of magnified that game of like 1031 till you die, and like just keep the
Yeah.
depreciation rolling. He's magnified that game on a quicker timetable than most people are comfortable with. So
No, I think I've been thinking about it. I think that makes a lot of sense because that's actually the downside of the 100% depreciation. And if you use it all up, you use it all up. So you got to figure out
yeah,
something for 2027.
that's right.
So you buy another one, you keep it
That's right.
rolling. Yeah,
Yeah,
no,
you
I
have to.
think I think it makes complete sense, and there's other strategies that we'll talk about at some point in time. So all nighter, yeah, depreciation recapture is a big one. So your buddy who you're buying from, he's going to have to calculate what that is going to look like. Now you're saying maybe a wrap will negate that. Another way to do it is to do a land contract where you actually don't take possession of the property until the loan is paid off. So when I bought my house, it was an installment sale where the deed title was transferred to me and we paid a loan to the seller. But the other
Mhm.
way you can do it is basically seller keeps the property, then you make payments, and then once it's paid off, that's when the property theoretically is sold, and that's when depreciation would be due. But all nighter, I'd encourage having you and your client reach out to talk to Taylor Tax Strategy, to Greg, for sure. So
Yeah, I'm happy
structure
to help
good.
with the details of that and helping with the structure. The best time to get these questions answered is before you sign the papers. So
Exactly.
definitely make sure you feel good about it before you sign.
Are you sure it's not October 14th? That's when you get the answers. No, I'm just kidding, just kidding. So, the cost segregation study. So let's talk about the 100% bonus depreciation. In order to maximize that for a piece of real estate, what you're gonna wanna do, because real estate is made up of, land and improvements. So the improvements are the structures on the land, and you can only depreciate the improvements, you can only depreciate the structures. Now you could guesstimate, which isn't a good idea, or you can do a cost segregation study. And the cost segregation study is going to break it down into the pieces and parts to say how much the pieces and parts of the improvements are worth together. And invariably, the cost segregation study is going to allow you to depreciate more. Is that correct, Craig?
Yeah, it's going to allow you. So basically, you're splitting up the purchase price into the different components of 5 year, 7 year, 15 and 20 year components. And so there's different things in buildings that depreciate over different periods of time when they're decided alone. But if you don't decide them alone, if you just lump it all together, like I bought this property, it's either going to be 27 and a half for residential or 39 for commercial.
So to be devil's advocate a little bit, with 100% bonus depreciation, it almost doesn't matter about doing a cost segregation study, does
Well,
it?
no, because you only get to bonus anything that's 20 years or less. So
Okay.
you can't depreciate that. You can't bonus out the really long-term stuff.
That is good to know. So
Yeah,
you're guessing if you don't do a cost segregation
right.
study.
And I'm not filing your taxes if you guess. So because you'll want me to defend it, and I don't defend that stuff.
No,
So
that's fair. I like
yeah,
that. I like
I
that
tell
about you.
people that if they're like, but I can get it done cheaper. I'm like, you can also get your taxes done cheaper at H&R Block too, because I'm not going to defend this DIY cost seg study that cost you $400 online where you got to pick the numbers yourself.
Oh,
So
oh no.
yeah,
And
so
yeah, and we've talked about you've got a good resource for cost segregation. Any idea what a rough cost a cost segregation study is? I
it's
guess.
typically 1 to 3% of the purchase price.
Okay.
So there's kind of a minimum probably of 2,500 to 3,000 is kind of like the absolute minimum that you would pay.
Yeah.
So you don't want to do it on something that costs less than 180 to 200 for the building portion or the improvement portion.
Yeah, that makes sense. It's funny because I'm thinking California prices. Sorry.
Yeah,
I'm
that's
thinking
right. I'm in the Midwest, so I got a fiveplex for less than 200 that I
that's
got.
crazy
So
to me.
yeah,
So, and we've talked about that on the air and off the air. You and I have
yeah,
talked about that. And that is a good topic to cover because cost segregation, speaking of cost segregation, when you buy a property in California, look, doors, windows, ceiling fans, kitchens, they can only be worth so much. And there's not going to be a huge disparity between what they're worth in the Midwest and what they're worth in California.
right.
Where the value is in California is in the land. So, really, to get the maximum value out of the 100% bonus depreciation and cost segregation, it makes sense to be buying in the Midwest. It makes sense to be buying in areas where more of the value of the properties and the improvements, right?
Yes, that's right. Also, it makes more sense to be buying if you're gonna buy in a place like California or Florida, a beach town, something like that. It makes a lot of sense to buy condos instead because they don't have land.
Interesting. Yeah. Except the darn HOA fees, but I guess it doesn't matter. You're trying to you're still gonna it's still gonna be a tax strategy. And also flesh that out more. So markets like California, those are appreciation markets. So over time, rent and value will go up. Although Los Angeles is an exception because of rent control, so your rent's not going to go up, but and your value is going to take a hit. But anyway, that's for a different discussion. So, and then Midwest, where I'm originally from small town Ohio, like the house I grew up in, that's under 100,000. That tends to be more of a cash flow market, not an appreciation market. So, it
Right.
all depends on your strategy, and that's why it's important to talk to somebody like Greg. So, hey,
And
Greg.
to know your strategy. I think I've shared a little bit about my parents here and how they're struggling with retirement age and trying to
Yeah.
figure out their strategy of what's the priority: tax, savings, cash flow, wealth building. And my dad just says, I want all of them. And
I know.
it doesn't work that way, Dad. So if you're listening today, it doesn't work that way. I tell other people that too, not just you.
No,
So
that's exactly like when an investor will say, "Hey, I'm looking for a good deal." Like, I'm like, "Well, what kind of cap rate are you looking for? The higher, the better." Well, it's like, of course.
yeah,
Okay.
yeah, yeah, yeah.
So, good news. We've got financial firefighter, great name, Aloha from Hawaii. So, financial firefighter, Greg is looking for somebody from Hawaii to get us to his 50 states. So, if you know
Yeah, yeah.
anybody who's looking
Love
for
to
help,
talk.
including you, reach out. And we got a link so we can do that. All
Yeah.
right, so All Nighter's got something else here. He bought a fourplex, turned it into five for less than 200, acquired for 160, put in 80, ARV's 450. That's great. You did a great job.
Yeah.
What's interesting there, All Nighter, what you did by adding the fifth unit is you took it from, as far as financing goes, you took it from typical conventional financing to commercial financing by having 5 units. So anyway, so in your neck of the woods and planning for your dad, what are you guys looking for right now? Is he buying more real estate? What's, if you don't mind sharing?
Yeah, so we're looking to buy. The big thing is in the Midwest, you can still get some good cash flowing assets for a reasonable price. So we are definitely looking into buying right now.
Yeah. Well, and all nighter, Mark is his buddy. So Mark's here. Mark's like, what did I do? And we're like, no, we're excited to have you, Mark. Thanks for coming out. So is there any reason not to buy an investment property right now? Which I know sounds like a loaded question, but honestly, what are your thoughts?
Sure. So I think if your priority is getting a really good deal, now is probably not the best time to get that property. So there are not a lot of good deals out there as far as like buying for less than market value. Everybody thinks their property is worth a lot more than it is.
That's true. That's the tough thing right now, the disparity between buyers and sellers. And look, every market you've got that disparity. That's always a problem. But right now, we've got record high prices all across the nation. Now they've backed off a little bit in some areas, but we still have mortgage rates. They're higher year over year, at not like 18%, but they're still tough. So it's tough to get a property to cash flow. Of course, you can put in more down payment to get a property to cash flow, but that defeats the purpose if you're trying to get a good deal.
That's
Do
right.
you, do you guys do much with, because I know the big beautiful bill had some energy tax credits that sunset in 2026. Are you doing anything with those?
So the biggest thing that was sunsetting, yeah, was some of those energy tax credits related to like solar panels and vehicles. Some of that stuff is sunsetting. So I'm telling people about it. It's not really that that impactful. I guess the solar panels can be.
Mhm.
That one's sticking around for a little bit longer. It's starting a sunset, I guess. And then the vehicles actually is already done.
Yeah, and I think there's some stuff in there maybe for developers who are trying to do a bunch of stuff. That's a bigger deal. But yeah,
Mhm.
for that's maybe outside kind of who we're dealing with. So Financial Firefighter has a great channel too, lots of great interviews, and All Nighter's a moderator. So that's
Okay.
why they're. So we got to let's get Greg and I on there. We'll have
Yeah.
fun, all of us hanging out. All right, so the let's talk about more about bonus depreciation. So it's not just real estate, but it can also be other things. Well, so it's not just real estate acquisition, it's also capital expenditures, correct? So if you decided to go ahead and spend a bunch of money on new roof, big remodeling to your real estate, you could do bonus depreciation for that, correct?
Yeah, you could definitely do the bonus depreciation for those remodels. And in that case, we don't always need the cost segregation study because we already have receipts, we already have invoices, we already have that broken down into the different components.
That's great. How about a if somebody wanted to buy a new vehicle for business, they could theoretically write that use the 100% bonus depreciation. It's over 6,000 pounds, correct?
That's right. If it's over the 6,000 pounds, and one little tip I'm telling a lot of people right now is if you have a vehicle that you want to buy, it's over 6,000 pounds, then you want to use the timing of the end of the year. So buy it within the end of the year, around 1-2 weeks left, and make sure you're using it 100% for business during those 1 to 2 weeks. And then for the next year and future years, you just have to stay at 50% or more.
That's great. I'm gonna get a new Lexus GX 550. I'm gonna get it on 12/30 or 31. Drive around, put some open house signs out, and then I'll be calling you.
Perfect. Yeah. And then the next year, you just have to stay above 50%.
That's easy. Trust me, I'm driving all over the darn place.
Yeah, I believe it.
Um, I think it's also important too because we're talking primarily investment property right now, but and to flesh out the analogy, the sport analogy that I loosely started with, there's two different playbooks. So your personal property, there's one playbook, and your investment property, there's some other playbooks. You guys help with both playbooks, correct, Craig?
We do, yeah. So some people are not real estate professionals, so because they have other sources of income, and so we have to look at other strategies to be able to use the real estate losses that you get from the bonus depreciation and other things like that. The majority of our clients have some kind of real estate investment because, frankly, it's the best tax strategy out there. But there are a number of different strategies other than that that we definitely employ.
Did you guys hear that? If you have need any more evidence that Greg's team knows real estate, he says real estate is one of the best tech strategies out there.
The
It's
best, not one of, the
Oh,
best.
the best. No, I love hearing that. Now I'm a real estate broker, so I'm a little partial, but no, honestly, I love hearing that from you guys because it's tough to find that specialty, somebody who's going to understand all the ins and outs of real estate. And again, like you talked about, family has owned real estate. You've personally bought real estate. How much was that fourplex? Was it a fourplex or fiveplex?
Fiveplex, it was around 160.
Wait, that's 160,000. Okay, and then
Not
what?
per unit. For all
Not for,
five.
yeah, the whole building, right? The whole
Yeah, the
thing
whole
and
thing.
the land.
The
What
garage and the land too.
what does it look like from an income standpoint? What's your gross scheduled income?
Yeah, so cash flows around 3,500 a month. So
Okay. So
almost 2% rule. Actually, I guess a little over 2% rule.
we don't have a 2% rule or 1% rule in California. We break that. We
You guys
break
don't do
those.
that there.
No, no, it's like the 0.5% rule.
Yeah.
That's amazing. So 3,500. Here, let me just run that cap rate. Sorry. So 3,500 is your NOI, you said. Well, that's your cash flow. What's your NOI? Do you have financing
No,
against it?
that's my operating income. Yeah, that's not my cash flow.
Okay, good. So
Yeah.
we're gonna figure out the cap rate. So 3,500 times 12, so 42,000, and you paid 160.
Yeah.
Okay. No. Is that a 26 cap? Is that right?
Well, you didn't take in insurance and property
No,
management
you
and
gave me the
taxes.
NOI. Give me the NOI. Give me your NOI, your net operating income after everything except for um, debt service. So tell me how much you're making, your true
Let's
NOI.
see.
I'm
Before
calling
debt
you out
service.
because you're a tax dude. So you
Yeah, so I
gotta.
have 10% in I don't have these numbers off the top of my head, but I have 10% in property management fee, and then taxes are around 3 grand on the year.
Okay, what's your gross scheduled income? Is it 35?
Yeah.
Okay, so 35. We're gonna use 0.7 for
Yeah, there you go.
expenses. Which is so it's actually 30%. I'm using 0.7 to calculate it. It's about 29.4 is your net operating income,
It's
and
still
then
really good.
no, it's amazing. So
Yeah.
divided by 160. So oh, I did it the wrong way. 1 second. 1 second. This happens to me sometimes. Let me start over. This is great. I'm live on the air calculating cap rates. Okay, so 20.7. Okay, now divided by the sale price of 160. This is worth doing. It's an 18 cap.
That
That's
sounded
insane.
more. That sounded
Even
more.
if it's a 15 cap if the expenses are slightly more than 30%. Holy crow. That's
Yeah.
insane.
Yeah, it's
So
crazy. Some stuff in the Midwest.
yeah, so an 18 cap, not bad. That's why we talk about. That's a cash flow market. Where here, you'd be lucky. I mean, in LA now, because of how tough it is to sell. So in LA, there's a few challenges for multifamily. There's rent stabilization ordinance, which caps how much you can increase your rent, 3% right now for rent stabilized properties. And then there's the LA City Measure ULA, which charges additional transfer taxes of 4% for sales above 5, and for sales over 10, it's 5.5%. Anyway, long story short, cap rates have gone up, so you can now acquire stuff at 6.5 or 7, which is a great cap rate for us
Yeah.
out here.
Yeah.
But in Orange County, it's going to be like I sold a building, a 22 unit building in Costa Mesa at a 5 cap, and we had multiple offers. We had 5 offers for that. Anyway,
Oh,
I
yeah.
digress. So that's cash flow versus appreciation markets.
Right. Well, and too, I paid 160 with the land, so I'm not doing a cost seg on that building. So I'm
Yeah.
not getting a tax advantage on like an additional tax advantage on that building.
No. So you're not going to be able to bonus depreciate or what?
No, I mean improvements I can bonus depreciate, but
Yeah.
nothing with the purchase price because there just wasn't it didn't make sense. What I would save in taxes, I would pay the cost seg study place to
Yeah.
do this. So
That's a fair point. That's a fair point. Yeah, based on what we talked about before. See, this is good. This is helping us expand our awareness in different markets from both sides. And
right.
then the personal, so, and we talked about this one of our first times we were on the air, the fact that a personal residence is a liability, not an
Yes,
asset. We
that's
agree
right.
on that. And I mean, what strategies are there? And we've talked about a few of them. What are some strategies for a primary residence, like the Augusta
Yeah, so
rule?
Augusta's going to help you if you have your own business. Otherwise, you're just bringing in income. You can still do it without having your own business, but you're just bringing in income that's not taxable. So it still helps you because you can still rent it out like on Airbnb. I think I might have mentioned I'm in Louisville, so we have the Derby. So a lot of people rent their house out Derby week for people from California who come in to watch the horse races. And so when that happens, then those people get that money from Airbnb. If it's less than 2 weeks, 14 nights per year, they don't have to claim any income on that. They don't even have to put it on their tax return to
That's
tell the
great.
IRS they got it.
That's
So
just
it works that way too. As a primary residence, just extra income.
that's smart. I could see how you could set it up to where even as a W-2 employee, you could basically say, okay, I'm going to take a 2-week trip to Europe and I'm going to rent out my house while I'm gone to help cover some costs. Yeah,
Yeah,
that's
that's
smart.
right.
You
Yeah, if
could,
there's a festival going on in your area or some kind of big like concert event or a NASCAR event or whatever, it could be a sporting event of some kind, maybe a World Series or something, like that, then you're going to have multiple days that people want your property. And so
yeah, we got the Olympics coming to LA, so
there you go.
that would be a good time to do something like that. And the
Yeah, you could get huge
World Cup is coming too, I think.
yeah.
So, what other strategies for non-business owners that are just trying to save some tax money?
Yeah, so big ones, and this kind of is something you need to be aware of starting November 1st. We have an open enrollment coming up for your health insurance, and you get to plan what type of health insurance plan you want. If you have a what's considered high deductible plan, then you qualify to have an HSA, health savings account. And if you have that, you can put money into a health savings account that is deductible. So if you don't have a health savings account or something, you have to have over 7.5% of your adjusted gross income be spent on medical expenses before you can start deducting the first dollar on your taxes. However, if you put money into an HSA, which you have to have the high deductible plan to do it, but then if you put the money in the HSA, you deduct it off your taxes right away or at the end of the year, sorry, like on your tax return that year.
Yeah,
Then you use that money that is tax free to pay your co-pays, to pay for your over-the-counter drugs that you get, Tylenol, like Band-Aids, all those types of things.
yeah,
Pay for even sometimes like acupuncture, massage, chiropractor, even some stuff that isn't always covered by your health insurance. It can also help you pay for your deductible if something big were to come up. So that can be a really good one. It's a way to make sure that health insurance, that those health expenses count. Another thing that you can do, and this is one that I employed a couple years ago. I have some back issues and spinal cord issues that have come up in my life, and so I got a hot tub. Well, if I just buy a hot tub for myself, that's not deductible, right?
yeah.
But if I get a prescription from my doctor for a hot tub and I have the money in my HSA, I pay for the hot tub out of my HSA.
That is a spectacular tip. We have a roving hot tub festival, I guess you'd call it, or like at the fair, they come there and they're like, everything must go. All these hot tubs have to go. So this is spectacular. Just get a prescription and have the HSA, and you can have yourself a hot tub. I
Yeah,
like
so I mean, it would probably take 2 years of HSA contributions to get a hot tub, probably out there in California. 3 years.
that.
It would take me about 2 years of maxing it out to get it here in Louisville. So
I
maybe a
love it.
third year for you guys. But yeah, you have to basically go over 7.5% of your income before you can deduct it, unless you have an HSA. Then you deduct your contributions to that, and then everything medical related gets paid for out of that.
And I've heard people, and this is me just talking, so I could be completely wrong because I don't know tax stuff like you do. But some people use HSAs like investment accounts, like they're investing it. And
Yeah, you absolutely can do that. So sorry, I just saw All Nighters comment there and
no,
distracted me.
he
I thought
doesn't.
all
I thought all
prescriptions were bad.
prescriptions were bad.
So
I was
hot
like,
tubs and swimming pool prescriptions are not bad, All
all
Nighters.
nighters going straight to the doctor for his hot tub.
Actually, after we hang up, I'm probably going to get my hot tub. It's a little cool here in Kentucky tonight, so might
One
be
of
a
the
nice
next episodes
evening.
will be
So,
next episodes from your hot tub.
yeah, there you go. There you go.
But yeah, we were talking
Um,
about, sorry. So the people use them as like saving, like investment accounts. What do they?
Yeah,
How do
so
that
I
work?
think this is really cool. So there's not a rule. You can get reimbursed from your HSA for medical expenses if you don't use it in the year. Like it rolls over, it keeps growing. You can invest it in like they even have self-directed HSAs. So if you had enough in there, you could buy real estate or private money lend out of it. But
Yeah.
even if it's in mutual funds or whatever, it keeps growing. So I've heard of some people. I have not had a client do this yet. I have some that are on their way. But I've heard of some people like not using their HSA. They got it up to like $200,000 in their HSA, and they literally saved every receipt for like 20 years. Uh, and then they reimburse themselves all of it in 1 year.
Oh my gosh.
And none of it's taxable because it's your HSA and you have legitimate receipts because there's no limit on the time for those receipts. And so they use it as a tax advantage savings account. Then
Yeah.
they save every year that they paid their deductible of 10 grand or 5 grand or whatever their family deductible was, all of their CVS receipts for $20 for, prescription copays,
The CVS
doctor's
receipt.
copays. Oh yeah, that's true. Yeah. They're like, one of those, it's like, where's the actual part that I paid on this thing? So, but yeah, they save all those receipts, and have all that. And then they reimburse themselves all at once. And so they get this big fat check and it's enough for a down payment or a nice European vacation or both,
Yeah.
or, a house in the Midwest. So
There you go. Buy an investment property. Buy a hot tub in the Midwest that comes with a house.
yeah, there you go. There you go.
What and you mentioned something I actually wanted to touch on briefly. I'm glad you mentioned that is private money lending inside retirement accounts. That's something I want to do for 2026. This year I started private money lending, and I'm a big fan of it so far because
Yeah,
nothing's gone wrong, knock on wood. But it makes so much more sense to me if I can set up a self-directed account that's a retirement account to invest in private money. Any downsides to it that you can think of? Like, what happens if it goes bust in a retirement account? Like, I
Yeah,
don't
so I
get
have a client who's going through that right now. It would be a loss, just like any other loss, if it does.
okay.
But for them, I said, well, we have a couple options. I said you can write a 1099-C cancellation of debt to this person. But if it's secured by anything, which most of the time private money is secured by real estate,
Yeah.
either in first or second position. And if it's secured by anything, you do have to go through the foreclosure process first. You can't
Yeah.
just decide to wipe it out. So you can't just like harvest the loss, if you will. So you would want to do that. If it's inside a qualified account, you just got to kind of follow that process with the right people. So the thing that happens in a qualified account is you can't do any of that work yourself. So if you want to foreclose, you can't go down and file the paperwork. You can't file the paperwork to evict the
Yeah.
person. You have to hire an attorney because it's in your qualified account. And any efforts or work that you put into that saving any dollars is considered a contribution to your retirement account. And it doesn't
Interesting.
have a clear value. So the IRS says if you do this, you've nullified it being a qualified account.
That's
Because you can't qualify the value of the
that's a
work.
great tip right there, and I appreciate you bringing that up. Yeah, and the private money relationship I have right now, they do handle all that, even though it's not currently qualified funds. But yeah,
Mhm.
they handle all that anyway, so that's good to know. And I think it'd be good to maybe have a contract that states that
That's right.
going in, and that's
Yeah.
just like if the IRS ever comes knocking, then you can say, "Hey,
Well,
this is what I got."
yeah, even people who buy a property within their 401k, they'll be like, "Oh, I'm just going to go over there and fix that doorknob or change that light bulb on the front porch." Like I mean, I'm not going to tell on you, but like if there's any way that we have proof that you did that, or that it can be proven that you did that, you've just nullified the whole thing because you wanted to save $30 on a handyman for 1 hour, or whatever. And maybe in California, $60 for a handyman.
Yeah, no, that's great advice. And I
But
could see cases where renters that are not happy with their landlord could go ahead and turn someone in if they wanted to be vindictive enough and had that figured out. No, that's
yeah, if
great.
they were aware, yeah.
Yeah, that's great advice. So, look, this is amazing stuff. Time is flying with you, and who would think talking about taxes, time would fly by like this? The 1031 exchange, so that's still alive. I know everybody likes to like a lot of real estate brokers like to say, "Oh no, it's going away. You better take advantage of it now." I never do that. I know it's going to be here for a while.
I think
What?
it's got to be. I don't see that going away.
Yeah. It's especially with as many politicians that own real estate.
Yep.
Any special advice now you're giving? I know, like we talked about, the bonus depreciation changes things a little bit. Any special strategies in 1031 exchanges for 2026?
Not necessarily the 1031 exchanges, but I am being really specific with my clients about what types of property they buy, which we hit on that a little bit with the land value. And so the condos, I had another client say they were in Hilton Head Island in South Carolina recently, and they sent me a text and they were like, "Hey, we're looking at places. What about a townhouse? It's like a really tiny lot." And I was like, "Yeah, that it's going to be better than a home with a big lot, right?"
Yeah.
So just being specific about that. And then the other thing, and I think All Nighter might have mentioned this with his fourplex, turned it into a fiveplex. Um, that's going to have, anytime you're buying multifamily, you're going to have more of the kitchen and bathroom stuff, and all of that is shorter term depreciation. So instead of having one kitchen, he said he spent around 450 was his ARV. He was all in. It looks like at
Nice.
225 or so.
Yeah.
But yeah, there's multiple kitchens, multiple bathrooms. Your cabinets depreciate faster. Your appliances do. Specialty plumbing, which is typically in kitchens and bathrooms. Specialty electric, typically in kitchens and bathroom. So all of those things bonus depreciate. The only thing that is maybe a negative on the kitchens and bathroom is ceramic tile doesn't bonus depreciate. It's
That's
considered
funny.
a long-term asset. So that's why we have hardwood in our kitchen right behind me. So
That's funny. Do you have a list of short versus like long term, like other than ceramic tile
I mean,
and
I have the basic ones in my head, I guess, at this point, because I've done so many conversations about it and looked at so many of them.
yeah,
But I definitely look it up. Like if I'm doing repairs on a property that I'm going to burr and I'm going to keep it for a while, I will look it up if I don't remember when deciding certain materials.
that is what an amazing tip and insight you just gave us. So that's strategic improvements with tax advantages. So that no, that's fascinating. We're gonna have to talk about that. Maybe next time we're on, you can give us some more items and we can run through those because that's a great insight.
Yeah, built-ins is a really big one. At least in this part of the country, people do built-ins, like around a fireplace or things like that, like built-in shelving, and so then that becomes like cabinets, and that depreciates faster. So different things like that.
All Nighter wants that list as well for short and long
Yeah.
term depreciation. Yeah. All
Honestly,
Nighter.
your quickest way is going to be just ask Chat GPT to give you that whole list, and
Well,
Chat will give
that's
you as many options as you could think of. So
no, exactly. But then we still need you to vet the list.
that's true.
ChatGPT is
That's
great. We
fair.
still need the pro to make
That's
sure.
fair. Very fair. Yep.
Um, and then planning for the future for those who are later in life, like your parents, like what special strategies there are you guys working on?
Yeah, so with my parents, they're kind of in a little bit of a better spot because my mom's a real estate professional,
Oh,
and
nice.
so we can still use some of that the real estate stuff. So for them, we're looking at, my dad has all this money in retirement accounts, and they want to be able to use it to buy real estate. But if you keep it in real estate, if you put all of your money into real estate from your qualified retirement account,
Hmm.
then at 72, you have required minimum distributions. So my dad, at first, when he was retiring, He was selling his company. He owned whatever percentage of it. I honestly don't even know. It's an ESOP, but he owned a decent percentage of it. And when he sold it, he was like, I'm just going to throw all that into my retirement account and buy real estate. And I said, nope, we're not doing that. And because then he gets to 72 and all of his money, qualified money, is in real estate. And he has a required minimum distribution, let's say of $100,000. Well, if he doesn't have 100,000 in cash every single year, eventually he's going to have to sell a property just to get money out, because the IRS or the government says he has to take it out so he can pay taxes.
Yeah, that's an amazing
we're
point.
getting it all out of there now. So while my mom is still a real estate professional, we're working on them buying some larger apartment complexes, like larger 20 or so units. So not like, 500 or something, but 20-ish units, 20 to 30 units. And then while my mom's a real estate professional, we can draw all that money out. My dad will have this huge earned income, or this huge, taxable income, but then my mom will get the cost segs and she'll be able to tank that back down for him, because she's a real estate professional. And then they'll have their money out of the retirement account. The government can't say you have to take required minimum distribution and pay us taxes, and they just get that control back of their money.
Do you realize how many golden nuggets you just dropped right there? I hope people realize just how much, this whole friggin' talk, all the gold nuggets you're dropping. Remind us, real estate professional, what you need to qualify as a real estate professional.
So there's two ways. The hard way, I'll say, is what you're doing, which is 750 or more hours per year. Working in real estate, it has to be over 50% of your working hours and over 50% of your working income. And then, so that's kind of how you qualify as if you're a regular real estate professional. But then if you're not in the real estate professional realm, there's the short-term rental loophole that allows you to do Airbnb. And then that allows you to qualify as for that property to be basically treated like you're a real estate professional.
How much work do you have to put in for the Airbnb to qualify?
So it's 100 hours per year. So like 2 hours a week.
Okay.
And then it is no other person can spend more time than you.
Okay.
So no other one person. And then the third thing is your average stay has to be 7 days or less. So you can still have a 30-day stay as long as there was a bunch of like 2 and 3 night stays to average it out, later. So you just have to have an average stay of 7 days or less.
That's amazing. Do you have clients who just happen to have an Airbnb just for that reason to qualify as real estate professional?
Yeah, I have a client right now that it's a logistics and shipping company that he owns, and they're not real estate professionals at all. They just buy Airbnb rental properties. So.
And he's able to qualify as a real estate professional because of an Airbnb?
Yeah, technically you're not. Technically, what you're doing with that Airbnb is you're basically saying it's its own little business.
I see.
And so you're not becoming a real estate professional. You're just moving it to earned income instead of passive, which is what rental property is if you're not a real estate professional.
Yeah, and you're limited too on capital losses versus capital gains in real estate sales, things like that. Yep. One of the things we'll talk about, I've got an exciting program I'm working with some financial planners on direct indexing. We'll talk about that next time. But as particularly as a way to offset capital gains on real estate sales. It's so friggin' cool. So all-nighter, he's loving what we're doing. Thank you, all-nighter. We appreciate that. Hey, and that means a lot because all-nighter freaking knows his stuff. So if we're teaching all-nighter something, we're doing something.
Yeah, awesome. Good.
So let's see. Let me see if I have any more questions. I know I'm going to be meeting with you on Friday. I got some stuff over to you. So I'm looking forward for our one-on-one together on Friday.
Yeah.
And we have a link that you guys can sign up on. Michelle can put it up. It'll be below this video. It's an affiliate link. I'll just put that out there. And it says it below. But yeah, it's not why I'm working with Greg, but it's just a nice benefit. So if you do decide to set up an appointment, please use that link. Reach out through there. If you're going to be searching for for a tax strategist, Greg, what are things to look for?
Yeah, so you want to make sure the person understands your industry. So, I have people come to me and they'll say, "Hey, I do drop shipping." For example, I had a guy come to me at a conference I do, and he said, "Hey, I do drop shipping. Can you help me?" And I said, "I'm sure I can help you, but I'm sure I'm going to miss stuff as well because I'm not in that space at all." Right. So, if you talk to me about, private money lending or subject to or double close, all those things I know because I'm in the real estate space. But if you start talking to me about, drop shipping and what that means and who holds the product and the inventory management of that, I'm going to have to learn that, and so I'm going to miss stuff. And
Yeah.
so you want to make sure you have somebody in that knows your specific industry, and preferably, honestly, somebody who's like family does it or they do it. Like I buy and sell real estate, I flip. I tried wholesaling and failed, but I tried it at least, right?
That's
And
all right.
so
Don't
um,
feel bad.
so yeah, so I mean, I know the real estate game. I'm sure there's stuff I can learn still, but for the most part, I know as much as my clients are talking about with when it comes to real estate. And so I stay kind of in the spaces that I know and understand, and I'm honest with people about that. And then the other thing I would say is if they are not as part of your fees giving you a regular scheduled time with them, even if it's just quarterly or twice a year, depending on, what you're paying and how much you're paying. But if they're not giving you a regular scheduled check-in, like we have check-ins, Christian, and then you have access, to our team for like, how
Yep.
do I implement this and all that stuff. But if you don't have that, then they're not doing strategy. They're just telling you they're going to.
It's
So
true.
there needs to be a deliverable. Either here's your plan on paper that you can follow, and like you just pay more money maybe one time to get that plan, or I'm going to check in and help you on the regular. So some kind of regular cadence. Um,
Well, and what I love about you guys is, yeah, we've got regular meetings set up. We can bounce different things off of each other. And I'm not locked into any sort of long term contract. If I say, you
right.
know what, Greg doesn't know what the heck he's talking about, number one, I'd be shocked. But number two, I could fire you. So,
Yeah.
and
Yeah. I
that's,
always tell people if I'm not showing you savings at least double what you're paying me, you should fire me.
yeah, I think
Um,
that's fair. I tell my real estate clients that too. Like, if you are not happy, let's have a discussion. And if you're still not happy, fire me. I don't want to,
yeah.
even if I've spent money on a listing or driven a buyer around for months, like, I
Yeah.
don't want unhappy people. Life's too darn
Yeah.
short.
That's right. That's right. I
So,
agree.
well, hey, I appreciate your time. I know it's been a long day because you've been helping folks across the nation in 49 of the 50 states, maybe 50 today, but you've been helping them, those who drag their feet a little bit and filed today. Don't make me feel bad. I
I
did.
did want to mention one other thing. I am actually doing a speaking engagement in your neck of the woods,
Oh,
in
seriously?
Las Vegas. Yeah, so I will be at a conference in Las Vegas at the end of this month speaking. I just have a one slot, so I'm not like the main speaker or anything. But it's called WealthCon,
Okay.
and the web address is WealthCon, WEALTH, like wealthy, and then con like CON.org. So if you want to go to the conference, stop by and see our booth, meet me in person, hear me speak, any of that stuff, you guys can check that out. And I'd love to meet you guys in person. So
That's awesome. What do you know the date off the top of your head or no?
yeah, it's October 30th through November 2nd. So it's like I think that's a Thursday through a Sunday.
You are in
Friday through
Vegas
Sunday.
for Halloween. That's
I am.
amazing.
It's gonna
That's
be crazy. I will not be out on the strip. I guarantee you that. So
You should be. The people watching will be amazing.
that's true. The people watching may be pretty amazing. So,
Well, we
but
appreciate you
yeah,
being
I'd love to
here.
meet anybody that comes. So please let me know if you saw this program and decided to come. So
Yeah, no, I'd love that. I know all-nighters always looking for any excuse to go to Vegas. So,
there you go.
hopefully, you guys show up to that. I appreciate you being here. Thanks for sharing so many gold nuggets. This is insane. I'm gonna have to watch this like 2 or 3 times to catch everything you said. So thank you, and I will see you Friday for our appointment, my friend. All
All
right?
right, sounds good.
All right. Thanks.